Wonderful, wonderful. Okay, so good afternoon, everybody. Thank you for joining us as again a very impressive turnout. Many of you do know me already. My name is Lauren Nieves. I'm the Director of Investor Relations here at Astor Capital. It's a pleasure to welcome you to this month's edition of Astor's GlassDoor Portfolio Review. We're especially proud to host this series each month because at Astor, we believe that transparency is not optional, it's essential. The GlassDoor series is our commitment to keeping our investors and potential investors fully informed, offering a clear and honest view into how we manage capital, evaluate opportunities, deliver performance, and also share our wealth of knowledge in this industry with you investors. So for those who are joining us for the first time, let me share a little bit with you about who Astor is. Astor is an institutionally backed private equity real estate firm with offices in Manhattan and Miami. We specialize in value add and ground up development across major US markets. Today, we manage a portfolio valued at over $3.3 billion, and we represent more than 4.7 million square feet of commercial and multifamily real estate. We're proud to say here at Astor that we consistently deliver returns that surpass industry averages. This is just one of many results of our disciplined underwriting, experienced leadership, and hands-on portfolio management. But beyond the numbers, it is our mission that guides us. At Astor, we believe in breaking traditional boundaries by leveraging our collective bargaining power. We're dedicated to leading our community of investors towards financial security and growth with integrity, authenticity, and transparency. For us, it's not just business, it's personal. And tonight, I'm honored to be joined by our CEO and the driving force behind Astor's continued growth, Joe Burko. Joe is a highly respected entrepreneur with over 25 years of experience in commercial real estate. He founded Astor with a clear purpose: to build a platform that puts investors first, combining a thorough deal structure with market-leading returns. Under Joe's leadership, we've participated in more than 26 ventures in 12 major US markets. His insights and creativity in deal making have earned him many national recognition and awards, including Power Broker by CoStar and New York Signature Broker by Clode Street. So before I hand it over to Joe, as always, we encourage a collaborative session. Please use the chat option below to drop any questions. We'll also have the Q&A we'll be answering throughout the session. And if anything doesn't get answered, we'll be, of course, reaching out to you after to address those questions. So Joe, on that note, I will hand it over to you.
Wonderful. Thank you, Laura. Thank you very much. Great to see everyone here. Thank you for joining GlassDoor. We try to do it once a month and a half. Whenever we have something interesting, we reach out to you. But on a consistent basis, like Laura said, it's important to us to be in touch, to share with you not just about your deals, not just your investments, but also what's going on with the company. How do we see the market? What do we look to watch out for, and all the good stuff that helps us reach our decision making as to where to place capital next. Also with us is Andrew Milbank, the CIO, Chief Investment Officer of the company. We also have Sebastian Lacayo, who's in the analysis side, and Alex Mockery, who's on the analysis side. So let's just dive right in. If we can put on the presentation, Laura, that'll be great. Okay, wonderful. So summer of 2025, what's happening with the world, and really how does it affect our business decisions and investment interest in various chapters. So those are here that are new, just a high level Astor by the numbers. As of this quarter, we have 38 transactions, Laura said 26, we have 38 transactions, 16 exits. We're expecting by the end of this year to reach 20 different exits. We, until today, performed in investing in 12 top performing markets, US markets. These are markets that are growing both in terms of job growth and, of course, population. over 4.7 million square feet. We're managing $283 million for our investors and, of course, our own capital as well, with assets in values of over $3 billion, averaging across all of our strategies 22.3%. Give you a snapshot of where we are geographically. We've had one investment exited in Chicago. We have ongoing investment in Phoenix, Arizona, Dallas, Tampa. We've exited. Good concentration in South Florida, one of the strongest markets in the United States. Columbus, Ohio, which we'll talk about today, is an asset that we're on contract to sell. Flemington, New Jersey will be up for sale sometimes in the coming months, or we'll create our own exit. We have several left units in Manhattan on one project, exited from Queens, ongoing projects in Brooklyn, New York, and soon to exit from our Westchester, New York transaction. So while we're looking into microeconomics of various markets, we cannot overlook the macro effects that are happening in the world. I'd like to ask Alex to join me for a couple of minutes and talk a little bit about what's happening in the Middle East and how do we see or how do we think things may or have affected our markets here in the States.
Thank you, Joe. Yeah, I wanted to take a few minutes here to talk about what's been happening in the Middle East. Obviously, the last 3 weeks have been dominated again. The news and the basically this could have major implications on any type of industry. So I just wanted to take back a step back and discuss really what has happened or how did we even get to what's happened before. Just a slide back again.
Sorry.
Obviously, this war now has expanded. It started October 7, 2 years ago, where Iranian proxies had attacked Israel, and fast forward a year and a half, Israel has started a preemptive strike against Iran. Mainly its key infrastructure facilities, the nuclear facilities, and senior leaders. Just about a week to 10 days later, the US actually engaged as well and launched a surprise attack on those, I guess, what they called like indefensible or indestructible nuclear facilities that the Iranians have, because there was, intelligence that their uranium has enriched to levels where it was just weeks or months until they had the capacity to build nuclear weapons. Shortly after that, obviously, Iran has responded by firing missiles on US bases in the Middle East, but there was no response. The Iranian missiles were communicated ahead of time with the US and Bahrain, and there was a ceasefire agreement very shortly after, which was violated. But basically, long story short, Trump called it a 12-day war. So why am I recapping all of this? Now we can switch to the next slide. Basically, all of this could have had the potential for some major implications. Iran controls the Strait of Hormuz, or they have at least the capacity to control it. The Strait of Hormuz is important because about 20% of global trade, oil trade, goes through that strait. The majority of that oil goes to Asia, and about 27% of that oil that goes through there goes to China. Europe and North America only buy a fraction of the oil from there. But what happens if Iran actually blocks that Strait of Hormuz? It forces those Asian countries to get their 20% of global supply from somewhere else. So then HSBC, Goldman Sachs, and JP Morgan had estimated that the prices could rise up to $130 per barrel within an extremely short period of time. So just as a reference, right before the war broke out, or at least expanded, the price per barrel was about $73. So that's about an 80% increase of what could happen to oil prices if they had actually closed that strait. The second strait I want to talk to is the Bab el-Mandeb Strait, which could be controlled by the Houthis in Yemen, which are allies by the Iranians. and that would have also, temporary inflation pressure for the European markets and therefore also the American markets for everyday goods. Um, Basically, what ended up happening though is that none of that happened. The attack from, or the, I guess, counterattack from Iran was seen as rather face-saving and not escalatory because none of the oil enrichment facilities were targeted. And the US actually also didn't respond to this. But if all of this had happened and the oil prices would have increased, what would this have meant for the US? Well, likely, you know, rising oil prices would have increased the pressure on inflation. If inflation is high, the Fed would have kept interest rates elevated or maybe even increased the interest rates, which would cause a slowdown of demand. And what that means for real estate, if the interest rates are still high, then obviously we're stuck in that current position that we're currently in, whereas we all want lower interest rates. So thankfully that didn't happen. So what actually did happen was that the oil prices decreased to $65 because of the reasons I just mentioned. It was rather seen as face saving rather than escalatory.
Mhm. Thank you, Alex. I appreciate this. Um, interesting summary, and really what else we're watching. So we're watching obviously the war in the Middle East, with the eye, of course, on um, you know, is there going to be global escalation? Doesn't seem to be the case. We don't have any major forces coming in, and it looks like things are somewhat better than expected. And the flow of energy has not been affected. On the contrary, probably we're seeing the decrease because there was uh, some concerns that have caused prices to increase, which never materialized. So good for that situation. The other area that we're watching very closely is the mayoral race that's happening right now in New York. And we're already taking the stand that the mayor race is going to be given to the Democrat candidate. Um, there's some concern about that, more than just concern for the real estate market. There's concern for New Yorkers themselves. It's a very extreme view with the current mayor and what he's running. Um, Ultimately, what could be the impact on property levels in New York? What could be the impact on New Yorkers in general? And we're sort of like seeing it as a tale of two stories. So we are taking the stand that the socialist, I would even say extreme socialist, that's now running for the city of New York is going to win. And the reason for it, it's, if you're in the Democratic Party versus the Republican Party or even an independent, the chances that the Democrat would win are 6-1, some even say 7-1. So it's almost a no contest. So we have to take the stand that this will actually happen. Now, there's a lot of statements that are being said by the progressive mayor, potential mayor, future probably. And a lot of them are getting a lot of us uncomfortable. Things like, universal rent control, and there will be no more increases in future rents. Those things would literally send some kind of a shivers down real estate owners' spines, because obviously they rely very heavily on those rents and they rely very heavily on future increases to keep up with inflation and rising costs. Now let's try to decipher the words, the noise from the actual truth. The mayor doesn't have the capacity to determine whether rents will grow or not grow. It's a different body. It's called the RGB, the Rental Guidelines Board, that determines if rents will continue to rise or not continue to rise. For an example, this week, that board has decided that any increase for 1 year lease will be 3%. And I think it was 4.5 or even 5% for 2 year leases. So it's nice slogan and it's nice stuff to run by, but it has nothing to do with the truth. The second thing that we watch for is going to be essentially basically the budget of the city of New York. We obviously have a lot of properties in New York. We want to make sure that things are going the right way. Well, this week, the current mayor, Mayor Adams, has passed the budget, $115 billion, and that is going to be taken into effect in fiscal year 2026, which means that nothing will change in terms of budget until sort of like the middle of 2027. Our stand is New York is in a rental crisis. That crisis has actually happened because of changes into policies that have affected New Yorkers in 2019, and we're seeing the implications today. And one of them is that nobody wants to build, nobody wants to fix apartments, buildings. Older buildings are not being fixed. There's no physical, and there's no incentives to do it, and so less available apartments, less affordable apartments. And what we're seeing, the apartments that we're offering to the market are achieving rents that we never expected. Some cases, $150 a square foot, $130 a square foot. Some of you are investors in those deals. And then rents continue to escalate. Why? Supply and demand. People want to be in New York. Young people want to be in New York. Young professionals is the very same people that are actually going to be voting for that new mayor potentially that will be coming in. And so our stand on New York right now until the middle of 2027, we don't see any significant risk into valuations or anything that will change the budget of the city of New York. However, post 2027, middle of 2027, 2026 into middle of 2027, it's a different conversation. So we have to wait and see, we have to watch, and we're following everything that's going on very, very carefully. I had the pleasure and the privilege of serving the state of New York as an advisor for 9 years. I was nominated by Governor David Pedersen in 2009 to sit on the board to represent the public of the state of New York. And it was a fantastic position. I was 36 years old at the time. I'm just giving up my age. I was 36 years old at the time, and I was sitting at the same table with all the decision makers, both in the public sector and the private sector. That nomination continued over with the next governor, the following governor of the state of New York, at the time, Governor Cuomo. And so for about 9 years, I sat down, and not only was I involved in the public sectors with my work, both on the advisory side, the brokerage side, and of course on Astor side, I was also very much in the kind of like first seat, watching and learning and being part of the conversations as they were going on the public sector. And I have to say that, New York for us has always been a short-term goal. So we always say never bet against New York, but our bet is very short. Every transaction we do is a short-term transaction. Why? Because we're expecting changes, changes in policies, and we don't want to get stuck in any long-term project in the state of New York, so long that there's good amount of rockiness happening amazingly from the political side. Portfolio highlights, we have 38 projects, as I mentioned. We focus on 3 transactions pretty much every month, and then we share those with you. So in Columbus, Ohio, we've acquired an asset, a cold storage, 105,000 square feet cold storage, and it was sort of like old. We spent a good amount of money upgrading the facility. We ended up renting it out to a public company, a supermarket that uses the space for their goods, for their deliveries, all that good stuff. And then we just now are about to go into contract to sell it to a very, very large outfit, one of the largest institutional outfits here in the United States. I can't reveal the name just yet, but we're days away from signing the contract. And, we're very happy with it. Just to give you sort of like a high level of what we're looking at, our overall project cost is 18 million. We're selling the project for 22. Durations around 37 months, and our return is 21.5% average annual return per year. Okay, on a value add project during a soft market, mind you, and we're pretty happy with the transaction. Giant Eagle is our 10-year tenant. We're renting it for $13, which represents a good amount of increase from what we initially projected. I think it was $11.75. Doesn't sound like a lot, but once you multiply it over 105,000 square feet, it really adds up, and it really adds up on the value. We recently refinanced the senior loan, and as I mentioned, we signed an LOI on May 30th, and right now the attorneys are final drafts, soon to be executing this contract. And so those of you that are with us in Columbus, Ohio, we're anticipating, I'd say sometime during the summer, maybe before the end of August, to do our distribution and to exit from this project with pretty good returns. You can see here a little bit more about all of this. I'm not going to take you through the numbers, but those are in the project. Of course, you're going to get all the details. And essentially, I think projects, it's always nice to exit a project and to make nice returns for everyone. Our second project today is the Bergen, Brooklyn. It's a 200,000 square feet condo, very, very unique condo, specially designed by a world-renowned architect that have produced something that I think one of the most amazing, one of the most, I'd say, call it mid-rise projects in Brooklyn. Certainly, it's gotten a lot of press because of the design, because of how thoughtful the public areas are. And I think we're doing exceptionally well, both in terms of sales. We just surpassed the 70% sales in this condominium. Our dollar per square foot point have also increased significantly higher than what we've anticipated initially in our presentations and in our projections. Again, it's 105 units. Total cost is 160 million, and we have over $100 million in potential profits. 51-month duration to date, and our projected returns essentially is 58% higher than what we initially expected. So we didn't think it's going to go as fast. We didn't think it's going to go as high as we expected. And so those of you that are in this project, knock on wood, we're 70% sold. We're past the point where we need to pay money to the bank. We're past the point where we, whatever mezz level we have, and we're going to start seeing distributions on an ongoing basis. Today, 74 units sold. As I mentioned, a little bit over 70%, 70.5%. We're very happy with the results. Again, a little bit more about the numbers and what are we expecting on a return level, which is, again, significantly higher than what was anticipated. Sometimes we hit the ball out of the park, but I think it's also a matter of sort of like how we see the market and how we sort of like underwrite things. But again, we still have, say, about, I think, 30 units to sell. A lot of the large units have been selling very well. And so long that we'll continue with the space, and there is no reason why we shouldn't, but so long that we continue with the space, we're looking at a very fantastic exit. The Conover, much smaller project, also in Brooklyn. Essentially, a project that got very much delayed during the period of time of COVID, and a little bit of a cost overrun. I'm not as happy with the returns as we wanted to be. We're making around 43% total annual return over the course of time. It's for us somewhat a mediocre type of returns. We just sold the last unit in the project. It was only 22 units. We just sold the last units. It's in contract and it's supposed to close sometime in the next 30 days or so. And we expect to exit in Q3 of 2025. Fantastic project, little project. Price point was right. Everything was right. The market over there, and I think we're better than most of the projects that are in the market in this particular area in Red Hook. And yet still, it was going very, very slow. We had to move between different brokers and different marketing companies in order to sell each and every one of those units. So I'm happy to say that in the coming month or so, we're going to be exiting this project. And I believe that, we're not looking for great returns, but overall cash from cash, on our level is about 43%. So that's essentially what the investors are going to see on their return. Not fantastic, but a good project to exit. Okay, that brings us to the top of our presentation. We do have several units left. We're not pushing hard on this project. And this is the reserve projects for those of you who are in this project. We're not doing Zoom calls on it. We're essentially expanded. We've taken additional capital. We love the project. We love the progress. This is a rental community with 350 apartments, surface parking. We're very far advanced. For those of you who want to learn more, feel free to run up the QR code and reach us to us. We have just expended another $1 million in our position, and we're talking to mainly new investors, although of course it's open to everyone, but mainly new investors are coming in. Going back to my conversation about New York, there's been a good amount of noise. Brokers are saying, it's amazing, mainly one broker that has been saying that he's been getting nonstop phone calls from people who are asking to sell their units as soon as possible so they can move to Florida. Okay, I think it's an interesting statement. We have not seen it. We've been speaking to a lot of the broker shops. There's some concern, as I said, in New York City right now. But we've seen this movie play out before, be it de Blasio. There's panic, a little bit of discomfort, and things go back to what they are now. As far as Astor stands, I think that the demand for South Florida, we're only focused on South Florida. And people sometimes tell us, oh, Florida condo market this and inventory is that. Well, Florida is a very grand state with 31, 32 million people. And I always try to speak mainly to the New Yorkers when they tell me, what about Florida? What's going on? And I tell them, look, the fact that somebody built in Rome, New York, and overbuilt in Rome, New York, or in Albany has nothing to do with New York City or with Brooklyn. It's very different buyers and it's very, very different markets. What's commonality to both is that they're both in New York. And that's essentially what's happening in Florida. We're seeing a very large supply coming into northern Florida, to the Panhandle, to areas where we never placed capital. We looked very carefully. And we always determined that that's not the spot for our investors' capital to be. And so we're seeing the effect of oversupplying those markets. South Florida also is seeing a softening. It's not from today. It's ever since interest rate went up. We're seeing a softening in the condominiums and ultimately a softening in the single-family homes. Again, when prices jump in a very short period of time by 300% or 400% in some cases, then essentially there's going to be some sort of breaking point when a lot of it has been induced by externalities. In our case, it was the pandemic at first, and then ultimately the policies in various northeasterners states that have drove a lot of individuals here. We are tracking, however, the amount of people that are still coming in. Florida, and mainly South Florida, is a very, very coveted market, growing market. And we feel that most of our focus is going to be away from condos, away from very expensive units, and into what we call where the largest demand. So think about the demand bell curve, right? And we want to be somewhere in the center and offer affordable luxury to individuals, young families who wants to stay here, be close to work, but don't mind traveling 20 minutes, half an hour, 10 minutes, 15 minutes to their workplaces. If there's interest, let us know. Otherwise, we're going to keep this one short. Thank you all for joining. And let's stay in touch. If you need to reach any of us, of course, we're available. Happy 4th of July, everyone. And have a great weekend.
Thank you all, everybody. Looking forward to the next one, and we'll speak soon.
You work hard for your money. It's time to make your money work just as hard for you.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena, I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
Feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.